Yeah, welcome to my video blog, Questions of Doubt in Corporate Valuation. My name is Bernhard Schwetzler, and our today's question of doubt is which models are capable to properly include fading growth in the terminal value calculations. This is part one. There will be a part two in the next session. Okay, so just a recap of our last question of doubt video. We have found out that fade factors or fade rates cannot directly be applied on growth rate because this is going to yield flawed calculations and flawed results for the terminal value. Yeah, so we came up with a proposal how to make it better. And the idea was that we either, based on the Gordon-Shapiro model and its idea to decompose growth into retention and return, we came up with the idea that we either may apply fade factors on rates of return or beta excess rates of return, or we may apply fade rates or fade factors on invested capital or operating assets, yeah? Or of course a combination of both. Today we will look at the first version of this proposals. We will discuss a model capturing a declining and faded invested capital base or asset base. That is, we look for the case where the invested capital is declining at a constant rate at a constant excess rate of return. Yeah? And that case is not as unrealistic as it may seem in first glance, because the idea is quite compelling that you say a firm witnesses declining margins and declining returns in a particular segment, and then it pulls out of this segment and still continues to make business where it earns its cost of capital or where it still earns excess rates of return. Yeah? So that's the idea. We shrink the asset base, but we keep the excess rate of return above the cost of capital constant on the remainder asset base that we have. Okay, so we look at two particular valuation models just to check on how to implement this in our valuation case. The first one is well known in the controlling. It's called in the value-based management. It's called the economic value added valuation model, EVA. And here the basic idea is that the value of the firm can be decomposed into the book value of its operating assets, that is the invested capital, here denoted as IC. And the second component is the so-called market value added. And the market value added is the present value of all future excess earnings of the operating business. Yeah? And you see here the term in bracket. This is the excess earnings. So NOPAT is the expected future operating earning. WACC is the weighted average cost of capital. And IC, T-1, this is the invested operating capital at the beginning of the period. So the second term is here the threshold. This is the so-called capital charge. And the difference between the realized earnings figure and here this capital charge is the excess earnings, and you see all future excess earnings are discounted with a WACC, and that yields then the market value added. So the total value is then the book value of the invested capital plus this present value of all future excess earnings. On the other hand, we have our well-known Gordon-Shapiro model, where our terminal value is the free cash flow in the first period divided by the difference between the WACC and the constant growth rate to infinity. So if we replace the free cash flow by NOPAT times 1 minus the retention rate, then we get this version here. And finally, remember our question of doubt video where we introduced the Gordon-Shapiro model. We can decompose growth into a combination of retention times return. And so then here substituting the retention rate by G over the rate of return on our operating assets, we get the final version of the Gordon-Shapiro model. So, and our job is now that we try to check on whether these two models, valuation equations, are capable to deal with this declining and fading asset base. So when first looking at the EVA model, this is obvious that this model is easily able to cope with this case, because we simply assume that the invested capital is going to fade out at a constant rate, which is here denoted G asset. So this is the growth rate of the asset, and G asset is smaller than 0. Yeah, so here you see that we simply say that the invested capital in T is the invested capital in the preceding period times 1 plus this negative asset growth rate. That is important for the calculation of our market value added, because here you see then the market value added again being here the present value of all future excess earnings, and you see here this is the excess rate of return, ROIC minus WACC. This is the invested capital, and now we say every period our invested capital declines at a constant rate G asset, and so you see this is reflected in this factor here, and this is the discount rate. Yeah. And now if we replace simply here ROIC minus WACC by the excess rate of return, which is in our idea staying constant, then we can easily express this market value added as the present value of a geometrically growing, with a negative growth rate, geometrically growing time series of excess earnings. Yeah? So you see that this is here the excess earnings in the first year, the excess rate stays constant with the invested capital at 0, and then we say that this excess earnings are declining at a constant rate, and so you see then the present value, the market value added, is simply WACC minus this negative G asset. Yeah? So you can see that our EVA valuation model can easily cope with this case of a fading asset base. Yeah? And the reason is that as here our asset base is declining at a constant rate, of course our excess earnings are declining at a constant rate, and that is then here reflected in this equation. So now let's look at the second model. The second model is our Gordon-Shapiro model, and the idea is now that we first adjust the Gordon-Shapiro model by calculating our adjusted retention rate. Yeah? So the idea is that knowing our negative growth rate of the assets and knowing our constant ROIC, we can easily combine these two things towards an equivalent retention rate. Yeah? And it's clear that as ROIC is positive and G asset is negative, that the result is that our retention rate also is negative. Yeah? So we have a retention rate that is smaller than 0, and that means that of course the free cash flow is greater than the NOPAT. Yeah? So we do not even keep the NOPAT on firm level, so we cash out a free cash flow that is even higher than the NOPAT. Yeah? So we have a negative retention. Yeah? So, and from here on, we can easily apply our Gordon-Shapiro model. Yeah? So you see here that we take our adjusted retention rate by G asset over ROIC and simply plug it into our Gordon-Shapiro model. Yeah? So note that this equation requires the Gordon-Shapiro model to be applied, whereas the value driver model, that is just assuming that the growth rate is driven only by the rate of return on the newly acquired assets, is no longer applicable. The reason is a shrinking asset base actually means that we have negative net investments, and so our value driver model always implies and assumes positive net investments, that is a Q that is greater than 0. So our conclusion is that a shrinking asset base combined with a constant rate of returns or constant excess rate of returns, this is not an unrealistic case. Yeah? So the idea is that the firm pulls out of unattractive markets and still earns success rate return in the remaining and of course attractive ones. So, and we have seen that both models are able to cope with the challenge to include this case into our valuation equations for the terminal value model. The EVA model easily allows the decline in invested capital to be put into this equation, and that translates then into a decline of excess earnings at the same constant rate. And after adjusting our retention rate, and as G is smaller than 0, ending up with a negative retention rate, we may also apply our Gordon-Shapiro model, and the result is then that our free cash flow is higher than the NOPAT. That is, not only the NOPAT is fully cashed out, but even beyond that, due to the shrinking asset base and the negative retention rate, we have an additional cash flow ending up in the pockets of the shareholders. So that's it for today. Thank you.